Hi, I'm Michael Taila, Director of Fixed Income at City National Rockdale, and welcome to this month's edition of Fixed Income Perspectives. With the second half of the year underway, fixed income markets continue to navigate the now familiar themes of heightened volatility, mixed economic data, trade uncertainty, and shifting monetary policy expectations. As a result, July performance was uneven, with U.S. Treasuries losing 40 basis points, while broader investment grade and high-yield credit markets remain resilient. The municipal bond market has lagged this year, but a closer look at performance shows short and intermediate-term bonds have delivered positive total returns. Year-to-date, most fixed income asset classes have posted gains, with attractive income opportunities continuing to support steady demand. In the credit markets, tariff-driven headline risks and fiscal policy changes have failed to derail performance. After spiking higher in April, both investment-grade and high-yield issuer credit spreads have tightened and remain near the low end of their historical range. The strength of the economy has helped support bond prices, while corporate balance sheets remain broadly healthy. Earnings are on track to expand at a double-digit pace for the third consecutive quarter, further underpinning fundamentals despite moderating global growth. The technical backdrop continues to be a tailwind as debt issuance has failed to keep up with investor appetite for bonds. Overall, we remain constructive on the credit markets and believe nominal yields offer long-term return upside despite relatively full valuations. Mixed economic data has kept markets on edge in recent weeks. As expected, the July FOMC meeting left rates unchanged. Despite the dissent from two committee members, the consensus is that durable economic performance, combined with inflation risks from trade and tariff policies, will keep the Fed on hold for the time being. However, July payroll data showed weaker than expected job creation and sizable downward revisions, suggesting a cooling labor market. As a result, 2- and 10-year U.S. Treasury yields have moved lower across most maturities in August, and markets are currently pricing in a higher probability of easing at the next Fed meeting in September. In the coming weeks, investors will look for signals of the Fed's next steps from Chairman Powell at Jackson Hole, as well as upcoming data releases for jobs and inflation ahead of the September meeting. In summary, bond markets have been resilient this year, with most sectors delivering positive, solid total returns. In fact, at the time of writing, longer maturity municipal bonds are showing signs of recovery, and the broad municipal market is now positive for the year. We believe fixed income investors will continue to benefit from attractive nominal yields and income opportunities, improving total return potential in the coming months. We also see growing evidence that yields may finally begin to drift lower. The Federal Reserve has not resumed rate cuts yet, but forward-looking indicators such as slowing growth, moderating inflation, and a softening labor market suggest that policy easing is increasingly likely before year-end. In that context, over the next 9 months, we now see a greater probability that 10-year Treasury yield could fall below 4% and remain there sustainably into 2026. Thank you for watching this month's edition of Fixed Income Perspectives. Please reach out if you have any questions.